Welcome, everyone. My name is Chase Brofman. I'm with the CSAC Finance Corporation. That's the California State Association of Counties. And we are really the business and member services arm of CSAC, which is your advocacy organization for counties all across California. And so we have a fantastic event today. One of our partners at Treasury Curve was able to get some gentlemen here to join us to talk about the markets. The topic of today is interest rates continue higher. Where do we go from here? And so we have a great panel. I'll introduce our panelists here in just a moment, but I want to kind of start it off with saying that, as you all know, Zoom has the capability to do chat and Q&A, and we will also have a poll question later in the event. So we love participation on that. If you do have any questions, feel free to ask as we are moving along. But today we have joining us from our Treasury Curve team, Nancy Jerez. She is the Director of Business Development. And then also joining us from U.S. Bancorp Asset Management, we have the Chief Investment Officer, Jim Palmer, as well as Marty Kerger. He is the Head of Financial Intermediary Sales. And so, gentlemen and lady, thank you all for joining us today. Really appreciate your time. And I know, as I'm sure you're going to explain, the markets have been wild with everything going on in the banking sector. And so, again, thank you for taking the time to join us today.
Great. So there's been so much going on. It's just going to be, I'm trying to figure out a great way to convey a timeline of all the decisions that have been made and what's been happening. So I think just going through the high end and dipping down to where the Fed, and I understand that's kind of the main topic of what people want to go to discuss and give our views on where we think interest rates are going. So Chase, if you could bring it to the next page, please. Great, thank you. Okay, so let's start up there. What's our base economic outlook? And it's interesting. So if you were to go back, and it's a short 2.5 weeks ago, is when Chairman Bernanke was in front of Congress and talking about how the economy had really started to grow again, and that there was a growing consensus that they need to be more aggressive about rates. Now, obviously, what's happened over the last 2 weeks has changed things. There's a lot of credit condition contraction there. And so these are offset. So in a lot of ways, I think we're back to where we were thinking for the February Fed meeting. So what does that mean? So for us, a base case would mean we are going to see slower growth later in the year. And this is shown in this consensus forecast here down in the bottom left-hand panel. We're talking 0, negative 0.3, positive 0.2. I think the key point here is that I don't know that a soft landing or a very mild recession will feel all that different. And what do I say that is? One, inflation is still going to be elevated. It's going to be greater than that 2% that the Fed is targeting. So somewhere, anywhere, I think consensus is around 3.6 for all of 2023. So what that means, even if you have 0% growth, you still got 3.5 to 4% nominal growth. So that's reasonably good. Unemployment may be rising, but it's important to remember we're coming off a very low base. The last February print was 3.6%. That is historically low. And actually, it was coming off the January number, which is 3.4%, which is a low in the last 68 years. So regardless of if the unemployment rate begins to rise, it is really coming off a low base. And so I don't know that the unemployment rate will get to a point where it would be noticeably higher. If it could have a forehand, still by the end of the year, I would expect it would. But remember, even that is a fairly low by historical standards. So another thing here, so despite all the tightening that has gone on, if you look back over the last year and what's included yesterday, that's 475 basis points. And really the economy has held up pretty well, despite all that. And so that lack of slowing growth, that lack of progress, there's been some progress in inflation, that we believe that the Fed will have to remain restrictive for a longer period of time. That'll play into our forecast as we move forward. So that's one thing to keep in mind. We do believe the economy is in reasonably good shape here. Next page, please. Yeah, the employment conditions. So this is driving a lot of things right now. It's driving the economy. It's driving the consumer. And remember, what we're seeing here is payroll gains and elevated wage growth. So it's tough to see the consumer spending falling off a table if people are employed and they're getting raises. And to date, it seems like the Fed tightening had a lot of impact on the labor market. So that resilient labor market obviously is underpinning the economy and aggregate demand, but it also is driving some of the inflation forces through robust wage growth. Again, so if you talk about the same theme, that sustained labor market strong conditions is going to require the Fed to maintain a restrictive policy for, in our opinion, longer than what current market expectations are for. But just taking a look at some of the charts here again, we are coming off two very strong monthly non-farm payrolls, probably overstates strength in the market. But it's important to remember, we only need 100 to 150,000 in monthly job gains to keep the unemployment rate from rising. Also, too, what are some of the best real-time indicators that we've got of where the labor situation is? Number one is the initial jobless claims. We had a number this morning, 191,000. That is near historical lows. And as you can see, it's really stayed in that range for quite a while. So I would say the labor market statistics passed the eye test for me. When I look around, it still seems like many companies, many service industries are still having a hard time filling employment, IT, things like that. Now, there's some very high profile announced layoffs in California. Obviously, that is important in that region. But then also that was where a lot of expansion came from. And I'd also say when you look at the aggregate number, I don't want to downplay it for the individuals who are impacted, but overall, it's not a huge impact to the overall numbers that are coming through. So again, in our minds, the labor market remains a source of strength, and still, even illustrated, we still have almost 5 million job openings versus available people in the workforce. Still, workers have a bargaining position at this point in time. Next page. Okay, so the consumer. Again, it underpins a lot of where we're going with the economy. For the most part, we have seen some strong numbers, probably going to abate a bit with what we've seen over the last couple of weeks, but we're coming into it from a pretty strong level. One of the things that we are keeping a close eye on is that the consumer is gradually releveraging, but they still have a pretty strong balance sheet in aggregate. Certainly, there are some income, especially on the entry-level income side, where things are getting strained a bit, where you may perhaps dipping into savings that was built up over the COVID with the additional federal supplements. That is declining a bit, but overall consumers are still pretty solid, and from what we can see, tend to continue to pay their bills. One other thing too that you might be hearing a lot about is the credit card balances are rising. There's no question about it, but that's coming off kind of that COVID dip, and as we get more into where the balances are going, we've passed previous lows. It's important to remember, while balances are higher, the economy is larger. So one of the things to keep an eye on is not only are balances rising, but is the economy's capacity to pay those balances rising with it. And again, the trend, if you look at that upper right-hand panel with that yellow line, as a percent of GDP, it is rising, but it has not reached previous levels in that 2016 to 2020 range. So something worth keeping an eye on. But right now, it doesn't seem like we have gotten overzealous on that part of it. Case, next page, please. Inflation. Okay. So we have definitely seen improvement from the peak. So we suspect the economy is past peak inflation, but we also firmly believe the next increment of improvement will be more challenging to get. Inflation is definitely proving stickier than what had been expected a year ago or even several months ago. So again, that for us argues that the Fed still has work to do. Yesterday at in his press conference, Chairman Powell really reiterated a desire to get down to that 2% inflation target. There had been talk that potentially one of the options for the Fed would be to raise a target from the 2% that had been stated for a very long time. I would say definitively, the chairman came out yesterday and talked about that no one should doubt the Fed's ability and resolve to get inflation down. And he specifically called out the 2% inflation target. So it seems like if they've got a goal, that would remain the goal at this point in time. So from an overall standpoint of where we're at there, I think inflation will remain a challenge. But there's a lot of things going on that could potentially offset things. So now we're getting to the bulk of it. Next page, Chase, and we can talk about the Fed. All right, so before we get to what our outlook is, let's touch a few points on what was done yesterday. So the Fed did raise rates 25 basis points, as I'm sure everyone is well aware. They did put the dot plot out. And if, like I said, if you go back 2 weeks ago, there was a lot of expectations that the terminal rate would be lifted. Basically, it came in for the Fed's projections that they are going to have another 25 basis point rate hike in May, and then that would be where the cap is. With the caveat, I would say that while the median forecast was for that 5 to 5.25 range, 7 of the participants thought it would be higher than that, and only 1 thought we were done, that we'd be at this level. So if there's an indication of the bias, it would be that the Fed thinks that they need to do at least 1 more at this meeting, or that was decided at this meeting. So a couple things I thought caught a participant's attention, investors, and they were picking apart on the business stage. And so one was when the chairman said they did discuss a pause. To me, that seemed incredibly logical. The choice was between a pause and a 25 basis point rate guide. So I think it's obvious you debate the merits of pausing at this point in time, given the stress in the financial system we've seen over the last couple of weeks. Prior to the meeting, I mean, I'd seen some forecasts that meant potentially a rate cut was in the cards. Really didn't see anybody saying a 50 basis point rate hike, given all that's happened. So that didn't seem like it should be taken as anything other than the Open Market Committee debating the 2 obvious options there. There was a language change in the statement that people were looking at, and it went something like this, where they removed the statement ongoing rate increases and substituted some additional policy firm. That seems eminently logical to me. Regardless of where we are at this moment, we were reaching the end game for rate hikes. So as you approach that, in each meeting, there's a debate about whether we pause here or the amount of rate hikes coming in the future. I think it's appropriate to note that. So some additional firming suggests, maybe another one, maybe 2, but it's not as definitive as ongoing rate increases. So I think that's all what it does. It's an indication the Fed believes they are getting towards their terminal rate. Obviously, things can change on a dime on those types of things. So we'll see, but that's where their mindset is right now. A couple other things I'd bring up there. They talk about closely monitoring incoming information and assess the implications. That is a clear acknowledgement of the reality we're in right now. There is financial stress in the system right now. As you can see in the financial conditions that we had talked about earlier, they have decidedly gotten more restrictive over the past couple of weeks. So that's an acknowledgement of the realities that we're facing right now, and it is part of their equation. But I would say this, it was pretty clear that the FOMC and Chairman Powell during his press conference really believe that they have the tools to deal with the financial system right now, and more precisely targeting the places that need liquidity. So our belief is the Fed's decision function is this. Banking system stability trumps inflation, which trumps growth and employment. So in the near term, what that means to us is the Fed's taking a 2-pronged approach. They are using the traditional tools of rate adjustments, balance sheet adjustments to deal with inflation. And in this case, they're shrinking the balance sheet in the proverbial quantitative tightening, where they're targeting about 95 billion in balance sheet reduction per month. and then they nudge the Fed funds rate up another 25 basis points. And then they're taking another tack where they are using their facilities to get direct lending to those, some of those smaller banking institutions that need the liquidity, and addressing that in a more direct manner. Remember, balance sheet and rate adjustments are very blunt tools, and they can have an outsized impact on other things. So I think the Fed is going to be approaching this in that way. And it's important to note, we'll get the balance sheet this week's at the end of the day today, but the prior week, the Fed actually expanded their balance sheet in a period where they're supposedly shrinking it. So that is a testament to the concept of what they are doing in addressing the system by adding liquidity where it's most needed. So, where are we now for coming up at the next meeting? So as you can see, this was printed before yesterday. So it's a little dated as far as what the Fed goes and what our expectation was, but I would say the statement can be read. So the Fed decision at May, I think it's May 3rd or something like that, we lean towards a 25 basis point rate hike there as well versus a pause. Those are the two choices again. So why would we think that? Again, it's for the Fed is, I think, in a position where they have got a target that they want to get to. And I think the sooner they get there, the better off they can be from a policy standpoint. And I also believe that the Fed tools will properly address a lot of the strains we're seeing. Doesn't mean we won't have a lot of volatility. In fact, the one thing I can most convinced of is that the yield curve will continue to be very volatile as we get headlines, people get comfortable with the environment, or there's more angst. That will continue. And I mean, we have seen a ton of volatility over the last 2 weeks. 2 years, for instance, are down, given today's move, they're down about 120 basis points. That is the bigger move that I can remember in my career. So that continues to play out. So we are leaning towards that 25 basis point rate hike. But I would say this, it is completely dependent upon where we're at in this current stress cycle. If conditions start to relax a bit, then we think they're going to raise rates. If there's still a tremendous amount of stress and we're starting to see some, excessive volatility in the system, perhaps they would lean towards a pause. So we'll have to see, and it's a bit of a non-committal, but I think it's an accurate one that we'll have to see how things are playing out over the next couple of weeks, or 6 weeks till the next meeting. And that too, I mean, the Fed acknowledged it, and it is a reality. The concept of how much of this tightening in financial conditions, how many rate hikes is that worth? Is it 0? Is it 2? Is it 1? That's unknown at this point in time. People can make estimates, but there's really no telling if that the impact on credit creation. So that will all play into it. So I think the base case, another 25, kind of is the path of least resistance. We expect that the numbers coming up as far as employment and inflation are probably going to be more reflective of pre-stress in the system, so they won't necessarily reflect what the last couple of weeks have been. So that will probably bolster the case to go, and then we'll have to see how things play out in April as well. So, final page, Chase. Again, just to reiterate, we do believe the regulatory response to the recent bank failures is adequate to contain the contagion risk. The action taken and the commitment to take should restore confidence and stabilize the system as we move along here. In the near term, like I said, the one expectation for sure would be that we are going to see some volatility. Part of it will be driven by the expectations for the Fed, and part of it will be driven by market participants in a flight to quality type transaction. That will play out for sure over time. But in our minds, when you add on that, we think another 25, and we don't think there'll be a rate hike in 2023. If there was, it would probably mean that Fed needs more aggressively address stresses in the system. But it's for us, we just don't see the inflation numbers coming down quickly enough to warrant a reversal or pivot in the near term. It would take something different. And that's why we are keeping a close eye on those financial conditions and see where we're going from there. And with that, Nancy, I will turn it back to you.
Wonderful. Thank you, Jim, for that. And certainly we'll take any questions specific to Jim's presentation after we go through this specific section on Treasury Curve. But what we wanted to do today, just given the environment that we've been in these last couple weeks with this banking crisis that a lot of us have been front and center in helping and dealing with clients, we thought it would be a perfect time to address the specifics around how investment accounts are held. And one of the things that people sometimes forget, they look at their investment policy, they think that they're within the guidelines, but one of the basics of how accounts are held is not captured. And so we wanted to share this with the audience because these are sort of the lesson learned as we've dealt directly with the failure of this particular financial institution. And so this is kind of a checklist for you to go back and sort of look at your structure and what accounts you have and see if you are sort of passing this test, just given what we had happen. And so in the last couple of weeks, especially before the failure, we were talking to extensive numbers of treasurers and CFOs who were learning how their structures were set up right in the midst of this. And that's certainly not the time that you want to be sort of going through and figuring out how your investments are held. So the first thing that you want to do is look to see, are your accounts held in your name, in the government entity name? And then you also want to ask how that account is set up with the asset manager. Is it set up in an omnibus structure, so it's in the name of the bank or the broker-dealer, etc., or is it in your name so that you are actually able to be viewed from the asset manager perspective that's holding that account, that it does belong to you? And then secondly, just making sure the structure of your account, that your account is just the assets that belong to you and not in a structure where it is commingled with other clients. So you would want to have an account that's segregated from other clients as well. And then one of the key things is the ability to change the settlement instructions. So we had a lot of CFOs that were saying, hey, I'm in this off-balance sheet money market fund, I'm fine, I just need to change my instructions. And they didn't understand, because their account was in the bank's name, that they could not change those instructions. And the funds that they had there could not be taken out until the FDIC sort of decided how everything was going to settle out. Now, the FDIC came in and guaranteed everything. We don't always know that we're going to get that in the future. So being able to very quickly change your settlement account instructions is very important. So as an example, if we had an investment in the First American Funds held on Treasury Curve, and it was coming where we needed to change, say for example, the settlement account was a particular bank that had a problem, then what we could do is just, as long as there was another bank that was set up, we could take those settlement new instructions, change it so it did not have to go through or settle the bank that was having problems. So you are able to quickly sort of divert your fund investment away from a bank that might be having issues. And certainly a lot of the regional banks are under pressure, and that sort of continues, and hopefully some of that pressure will be alleviated. But it is always good to know how your investment accounts are held. And we know you have to have a certain amount of balances in your checking accounts. It's just operationally a requirement because you can't have it at zero at all times. And so, but being able to know what amount you are comfortable with, and then being able to have an investment account structure that gets some of those funds out of that kind of risk and not having too much concentration. That was another thing we saw with a particular bank failure, was that all the rules of diversification were thrown out the window, and pretty much all of their assets were in one institution. And again, a lot of times they were not on deposit, but they were in products that were getting trapped because of the way they were set up, and there was not the control of the client to be able to change instructions and do the things so that they could be clear of any kind of issues. So it is good to relook at your investment policy as well, see what your language says, and make sure you codify what the practices should be so that it's something that can be looked at as an ongoing basis. The story that we heard a lot from the clients that were going through this situation is that at one point they said in a certain amount, it might have been, several million, not a huge amount, it wasn't hundreds of millions, but as time passed, the balances build, and there was not a check to sort of say how much do we have here, and is this an overexposure? So we wanted to share that. So the rules of diversification, diversifying your providers, and then being able to access them via a simplified approach. Ultimately, if you have multiple fund managers, being able to do it in a simplified fashion is very important, because having to manage a lot of separate relationships where you're having to have multiple portals, et cetera, becomes very cumbersome. And so, that is where the Treasury Curve solution is very helpful, where you can check the boxes relating to all these things that are the best practices, but then still have one technology solution to be able to very efficiently do what you need to do, have all the compliance and monitoring that you might need. And then as far as Treasury Curve, we make all the funds available, and certainly we would highlight the First American funds and certainly the Treasury Obligations Fund, which has really been a top performing fund going back to last year. And so, kudos to the team at U.S. Bancorp Asset Management for doing such a great job there, and doing it in an environment that is very challenging as well, but still keeping that focus on principal preservation, which is key to these money market funds. So we would highlight that fund as one that we have seen a lot of our clients utilizing and being best in class. And for many of the clients that do require multiple ratings, certainly being rated by all three agencies as well is a plus. So a shout out to the team at U.S. Bancorp Asset Management for doing a great job there. And then I think I would just take you to kind of our Treasury Curve solution. I think the core solution is, as far as being able to invest in Treasury Curve, get access to these best-in-class funds like the First American funds made available via Treasury Curve. There is no cost for this solution, and it gives you an avenue if you have a provider today looking to diversify and want to be able to check those boxes as far as having very secure ways that your funds are held. Then we think a great solution for many of you who are joining us today. And so that's the wrap up that I have. Chase, I'll go ahead and take it over to you.
Yeah, thank you, Nancy. Thank you, Jim. Appreciate that overview, and it really does highlight the value that Treasury Curve provides to California counties and counties across the whole nation. Actually, we do have a poll, and I want to launch that now. I'll give you an opportunity, attendees, to respond to that. It's a banking poll. It's going to ask you 4 questions, so take a minute, go through those. And then, yeah, Jim, thanks again for going through the market update. It was interesting. I did see on the presentation, because it was printed prior to the Fed meeting yesterday, and then you had the 25 basis point raise on there. That I like that. There you go. You nailed it. So that was super cool. It's always fun when that works out. Yeah, it does. Yeah, exactly. And it could just kind of substitute in the next meeting for that, because it kind of jived in with what we expect in May to happen. Great. We're getting these filling in now. Okay, I'm going to end this poll. Appreciate you all participating here. I'll go ahead and share the results on screen. Nancy, let's run through these real quick. I think it's really interesting. So you should be able to see those now. Looks like the majority of you use about 2 to 4 different banks. The majority of you do have more than the FDIC insured limit on deposits. And then the majority actually don't use a sweep bank account. Very interesting. And then a lot of you are also looking to diversify your risk across multiple institutions. Fantastic. Thank you.
Chase, do you want to see if there's any questions that we have from the audience?
Yeah, let me double check real quick. it looks like it's in reference to that third or fourth slide. With the rise in credit card balances and then the relatively low savings rate, where is the breaking point for the consumer? So it looks like, I mean, you know, you mentioned that they still have a capacity to pay those balances as the rise in GDP, but is there a tipping point, if you will?
Yeah, I would say it has more to do with the kind of that chart that was on the right as well, the ability to pay. You know, as we move forward here, there's probably some sectors of the economy and the, let's say that bottom quartile of income earners that is potentially being impacted by inflation. They've got to use their credit cards to kind of pay gas bills, pay food bills, versus just paying it out of you know, ongoing earnings. So I think as much as anything, that's a kind of an inflation story there. I think, but overall, at this point, if we were to start seeing that credit cards as a percentage of the economy rise over that 4% level, I mean, that is something that we would keep a sharp eye on. But as to what's a tipping point, that would be difficult to say. I'd say it's more in line with, you know, how much real earnings, if we can turn that around. If real earnings start rising, I think that would be very helpful to that problem. And that involves getting inflation down.
Wonderful. Thank you for that, Jim. Any other questions that we have, Chase?
That looks like it was it. So fantastic.
Okay. Wonderful.
Again,
well, thank you, everyone. And I'll turn it over to you, Chase, to close.
Yeah. Thank you, Nancy. Thank you, Jim. Thank you, Marty. Appreciate you all. We will have all the folks' information available after the webinar. We're going to follow up with the attendees. So look out for that. Again, appreciate you all taking the time out of your day to join us today, and we'll see you next time.
Thank you.